Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, December 8th, 5:03 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. State of the market, bear market rally fading. The fading put on hold today with a decent green close got us back above the 21-day exponential moving average on all the big cap indexes. So two closes above, and I get to take fading off here. Isn't that wonderful? Checking over here on the trend gauge, market leadership, still bullish. Quite a few have broken the 21, some of them reclaiming the 21 today as part of the rally. Short term, we're showing neutral. Arrow flipped from red to green with one close back above the 21, as I said, on the three big cap indexes. Medium term, using the 50-day moving average, all five of the major indexes above the 50-day. Long term, we're mixed also. We'll dive into all this when we take a look at the charts. What just happened today? We had a gap up of about 0.5% in the morning and a little bit of volatility, tried to sell it off, and we went back and forth up and above the 21-day and the 39.60 area all day, all afternoon, a lot of the morning, but in the end, we closed above it. And we'll give a win to the bulls for today. G6 up 0.98%. This is our five growth index ETF composite. S&P 500 up 0.75%. Nasdaq 100 led up 1.2%. That doesn't mean that Tesla was green though. No, Tesla finished red. More fears about Elon having to sell some of his Tesla shares to finance his Twitter escapade. And my hat's off to the guy for being an advocate for free speech. I hate that he's losing money, but hopefully he turns it around, makes it a useful, level, balanced free speech platform that everybody appreciates. Dow up 0.55, mid caps up 0.75, Russell 2000 small caps up 0.63, global diversified 60/40 up 0.33%. Bonds took a little bit of a break today. GROTECTION in-house up 0.35%. We'll detail our portfolio and the changes we made today when we go through the tail of the tape. But first, let's dive into why we do what we do here at Revere. I got sentimental yesterday and took it back 2 years. Let's go back and do that again. This was the COVID debacle, down 34% in 5 weeks. We applied the same rules to get out this year to avoid this big downtrend. We had about a 12% drawdown here. And it just goes to how is the market behaving if it's trending above the medium term, the short term green line, the 21-day exponential moving average, the intermediate term red line, the 50-day moving average, and the long-term black line, the 200-day moving average, like we were from December 2019, January through February, and then COVID shows up. Late February, big drop for 5 weeks, and then a recovery when it becomes apparent that it's not as deadly as some of the clowns disguised as scientists claimed it was going to be. And then a nice first starts with a getting back above the short-term trend line, the green line, then back above the medium term, the red line, then back above the black line. Again, below the black line here, we're maximum defensiveness because it doesn't matter what time period I bring up. If you're in a bear market and you're below the 200-day moving average, that's when you need to get defensive. Here is COVID, February to March 2020, down 35.4%. Here we are again, most of this year below the 200-day moving average. Not as bad as COVID, but certainly longer in duration, down 27.5%. These are the destroyers of your portfolio. You've got rules to get out and rules to get back in and a long-term positive expectancy. Why not get out, save yourself some heartache, some mental capital, and also your physical capital, and then you're compounding from a much higher rate because instead of losing 25, 30, 35%, you're down in the high single digits or low double digits. And that's the way we do things here at Revere. We make risk management our number one priority. You take care of the drawdowns, the returns will take care of themselves. When the market returns back to a bullish phase, 46% return in 2020 for GROTECTION. Let's get back to today, and let's get back to the S&P 500 so that you can you see what I see? Okay, so 2 days below 21, ugly 5-day sell-off. Really 2 days of consolidation at the top, no damage. It was Monday and Tuesday that did the damage. Wednesday, a consolidation day at the bottom. Not breaking a lower low, so that means we stopped going down. Then the little gap up today and continued strength during the day. Let's take a look at this 5-minute chart here. And you can see here's the opening down. I'm going to draw a line at 39, 50, let's say 55 here. And look how we got above it early, tested it again late morning, got back above it, tested it again around lunchtime, got back above it, tested it again early afternoon, and all throughout the afternoon, and got back above it. Closed strong, 39.64-ish, we'll call it. But we need more than one close above the 21, at least two to make a trend, and then see where we go from there. Still below the declining 80 MA also. That's something that we want to keep an eye on. Be nice to get back above there. And then we've got PPI tomorrow morning. I said wasn't aware of any major economic data, but PPI hasn't had the impact on the indexes that CPI has, but everybody's kind of on edge now, trying to figure out what's going on with inflation. So maybe it will have an impact tomorrow, but that comes out tomorrow morning before the close. NASDAQ 100 got back above the 21-day exponential moving average, closed right into the 80 MA. Let's go to the Dow Jones Industrial Average. Right into the declining 8 EMA. So we had two closes right on the 21. When we moved above yesterday's high, we bought a UDOW, an enhanced ETF in the Dow. Very easy stop out below Tuesday's low. Let's go to mid caps. Mid caps bounced off the 200-day 2 days ago, closed just a hair beneath their declining 21-day exponential moving average today. IWM small caps, a little bit worse, couldn't get back above, ran into the declining 21-day and failed below the 200, above the 50. So we got a squeeze going on here between the 200 and the 50-day. As those seem bound to meet up a couple weeks down the road. And who's going to win? We'll let the markets decide that. Let's go to the equal weight S&P 500. Bounced nicely off the 21, ran into the declining 8 today, and didn't break below the 200-day moving average. That's good news. The big caps outperformed a little bit today, as we noted when looking at the NASDAQ 100. So these up 0.64%, the S&P up 0.75%. What's continuing to lag is financials. And you can see up 0.17 today was red for most of the day. And in addition to financials, energy making a lower low. Opened very green, finished red. Energy and financials, the big drags on the S&P. Well, I shouldn't say big. Financials are have twice as big an impact on the S&P as energy does, and about 5 times the impact as energy does on the Dow. So let's go to equal weight. NASDAQ 100, back above the 21, very close to the 200-day moving average. Let's see what the VIX did today. I mentioned how the VIX had a close above the 21 yesterday, back below the 21 today. The moving average has flattened out. So this continues to move opposite of the markets, as it mostly does. How about, in addition to the VIX, let's go to bonds, TNX. This is the 10-year yield, a little bit of a pop today, still on a serious decline below the 80 MA. That's the purple line. How about TYX? Prices were down, so again, yields were up 1.7% today, but retraced not even half of yesterday's loss. Very steep downtrend for the 30-year. How about the dollar? You think stocks were up? Was the dollar down today? Yes, that is still intact, riding the lower. Very tight pattern here for 6 days at the bottom of this flat base here around this 28.30 to 29 area, something we need to keep an eye on. Gold, even though the dollar was down, barely up today, 0.8%, can't get above the 200-day moving average. Let's look at gold stocks, GDX. Tried to get above the 200, closed below it, riding the 8 higher. The rubber's going to meet the road here. Either the 8's going to give up or the 200 is going to give up. And finally, Bitcoin up a little bit today. Let's put that on a 60-minute chart. Still really not doing a whole lot, but it did rally in the afternoon. So recent, well, let's say making about 3-week highs there on Bitcoin. So those are the key charts from the index standpoint. Let's go to the tail of the tape. What was important here today? Let's see. Well, we got put call at 9.2. That's basically neutral. VIX at 22. That's still bullish. Fear and greed 57. Bull case, as I said, we've been battling between the bull and bear. Bear being below the 200-day. 2 closes below the 21 after giving up the nice move last week. Now back above the 21. So let's move this back to neutral. We want another close above it to get it back to green. Some news today, jobless claims were in line. I mentioned PPI tomorrow morning. Day count goes from down 2 with a consolidation of a total of 5 down to up 1. So moving off below, that makes yesterday's lows crucial to hold it. Expectations were neutral coming in as long as we were above 3,900 but below the 21, back above the 21 now, although playing ping pong around there. Not a decisive move. It looked in the afternoon. Let's go to very quickly to a 5-minute on the S&P 500. I meant to point this out. It looked like we were making a decisive move here above that 2960 area and the 21 for about 20 minutes. And then the headline hit that Microsoft, that the Justice Department was suing Microsoft over their attempted purchase of ATI, and it hit Microsoft and really hit the indexes. Didn't really make sense to me at the time why it hit them that hard, but it did undercut, but then reclaim going into the close. So that was a little bit of news. Levels at this support resistance area, between support and resistance on the NASDAQ 100, action up, and then I didn't fill this in, but it was basically a tight range chop most of the day. As we edit live here on the air, sectors, bond yields higher, semiconductors really strong today, and tech, biotech. Gold and silver would have expected better, but they basically were neutral today. Oil started strong, faded very quickly after the open. Bond prices down, the dollar down, and marijuana stocks. Lot of talk about this bill to make them get them off Schedule 1, and look how we ran up from 12 to 14.5 and gave it all back promptly over the last 4 days, as politicians, as usual, can't get out of their own way. From that standpoint, we'll go over the focus list here shortly, but let's talk about what we did. I mentioned how we got bounced off the 21. We bought UDOW. Let's take a look at 5. This was this is setting up to be, really, this is exactly how you want to gap up to act. If you've got a market that's, at least neutral or even in a downtrend. So 4 days down, not a surprise, as the market has basically trended down the last 5 days. So there's your big gap up. I've been talking about some of these gaps. And first, low risk entry if you didn't get the gap up. We did buy the gap up, and a perfect bounce off the ADMA today. Above average volume versus to the sell-off over the last couple of days. Volume was higher in the morning. When we bounced off here, we doubled up on this, so now we have a 4% position on this. Our stop 2% below the ADMA, which basically corresponds to about 2% below the low of the gap up day, which is what our stop was in the first place. So added to our position and really didn't increase our risk much at all. And then we trimmed a quarter SDS, which was our hedge against the S&P being below the 21 day. moving average. When we got back above it, we didn't get back above it decisively enough to take more of it off, but it did up our exposure from 0.44 to 0.66. What you see in blue is what we own, in addition to UDOW that we bought today. So bottom line for today, indexes break 5-day losing streak. The 3 big cap indexes are back above the 21-day exponential moving average. Let's go through the focus list now. We'll start with everything that we own in-house, starting with Boeing. Stopped on half of our Boeing yesterday, had a nice move up in the morning, but then the markets got stronger and Boeing got weaker. Kind of weird. Look at the big volume here, but then the pullback on lighter volume. But it did pull back. Basically, it closed where it opened. So all in all, a disappointing day for Boeing after some serious strength the first half hour out of the gate. So we're still holding 3% on that. Netflix, 4% position on this, continues to act fine, hanging around the 8 EMA. Steel Dynamics, continued strength on this, 4% position on this, making new highs. We get to 111, we'll be taking half of it off with a +2R gain, which would be about 15%. I talked about adding to 5 today. Mobileye, can't get any gusto together off of its yesterday on its earnings report. It was actually up by 10% at one point, but faded to give back half of that, gave back another 1.68% today. Still is, this is a tough chart to read because of how tight it looks like it's all over the place, and I guess arguably it is all over the place. It does have about an 8% ATR. But as we get more bars in here, it'll look cleaner. For now, it's trending above the 80 EMA. You can see I got a bunch of alerts set to it, but for now, we're just leaving it be as it is on the small side. SARK took a step back today as Kathy Wood actually eked out a gain today, riding the 80 EMA higher today. FAS, we continue to see weakness in the financials. Kind of consolidating here for 3 days down. As I said, I showed XLF down just a bit today, but look at the relative strength line, and it's not as bad there. It's really the banks that are causing the issues. You can see further extreme weakness, and we talked about this in our podcast today about the weakness in energy and the weakness in financials. We did our podcast a day early, so be sure and check that out. I believe it's actually posted now. As always, we want to take a look at, I was looking at Apple and Tesla, but we want to look at Apple, which is below the 21 and below the 50, but holding 140, and NVIDIA, which continues to show serious relative strength, hanging above the 21-day exponential moving average and coming into the 200 there. You get back above the 200, you now have my attention, and we'll be looking for low-risk entries for that, but it's here was its earnings, and it sold off on earnings, but it's recovered it back. So consider that the inflection point day. Volume was really not that high around earnings, so it wasn't sold off particularly hard. Remember, it was showing a lot of relative strength into earnings. Now basically went sideways for 4 weeks before reinitiating this attempt to move higher. I got an alert there around the 200-day, but again, we're looking for these big liquid stocks that are showing relative strength that institutions like to pile into to continue a rally. They can take big positions without even thinking about it because of how liquid these stocks are. 2 more, AEHR, second straight day up. So basically gave back all of this big down 11.5% day, continues to act like a leader, but a volatile leader. And finally, Dexcom, which we talked about last night, they got approval of their latest G7 product, up nicely near the top of this flat base on almost double average volume, ended up 4%, was up closer to about 6.5% at one time, but that looks pretty good. Medical stocks are known in times of a trying economy and recession to outperform. Financials don't, as Dan spoke loud and clearly on our podcast today, so be sure and take a look at that. Nice fundamentals here, still a pretty darn high PE. But approval with a new product, we like the end. They got a great reaction to their last earnings report, then formed the flat base, and now trying to break out of there. Before we go, let's take a look at a handful, actually 11 gaps higher, and how they could be played according to the rules that I follow, and how 5 fits in with this. So here's Starbucks. I gotta shrink that. You know what? Let me get rid of this so the charts look better. Let's get rid of the stochastic and just focus on how this rides the ADMA higher. This is what I look for. You get your gap up, you can get your entry on the gap up day, give a couple of percent below in case of market weakness, and the market was weak there. And then your pivot is either the high of that day or as close to the 5 or ADMA as possible. So here we consolidated for 4 days and then moved above it. So to me, the pivot would have been just the high of this flat base, 93.50. And then look how easy this is to hold, just going higher above the 10-day, or sorry, the 8-day exponential moving average. Market not always the best during these times, but if you bought at 93, it's at 104. About 11-12% gain in a couple of weeks, definitely better than what the market gave you during that time period. But that is the kind of if you take a picture of that, that's kind of what I look for in these gaps up on earnings. And if they fail quickly. ELF is another one. Here's the gap up, second day higher high. First touch of the ADMA was about 5-6 days after, and just continued to ride it higher. Now this is actually a 4 weeks tight. If you look at a weekly chart here, you can see the blue here, 4 weeks tight. A move out of here will be adding ELF to our portfolios. Been watching this very tight. Like to see some volume with the move, however, and of course we need a better market. SMCI, this is another one that worked until recently. I mean, really what we're trying to do is get as much into it and ride it as much as it is, and then take some profits if it starts to act squirrely around the ADMA, and then see what happens when it gets to the 21. So this initially had a gap up here, rode it higher, another gap up on its earnings, consolidated in the lower part after this gap up on earnings, very close to touching the ADMA, which was in the bottom part of that candle on the gap up day, and then just riding it higher from 80 up to here was about 95 before it started to roll over. This was a rough day. I probably would have taken some off here on that big break below, but it did give a close above the 8 and another higher high before gapping down here on 12.2. So I very clearly would have been reducing my position there. But my bottom line is I'm trying to point out how these ride the ADMA higher, and it's really a guilt-free hold. Now, I thought Sanmina was going to do the same thing, but it did not. Here's its gap up, day 2 higher high, day 3 higher high, pulled back, undercut on a rough day in the market, but reclaimed the 8 by the end of the day, ready to go higher, right? Nope, broke back below the 8, and then the 8 rolled over and it broke below the 21. This is one that just didn't work out, but your loss would have been minimal by the time that it failed. It really should start moving within 2 weeks, but this one just didn't. Electronic contract manufacturer had the group going for it, had the volume going for it, had the earnings going for it, but for whatever reason, there's more sellers than buyers right now. Halo, this is another perfect one. Gap up, higher high on a big volume again the second day. Pull back, first touch of the ADMA. If you didn't get in on the first 2 days, you can get in here, and it was just riding it higher. So assuming you bought at the ADMA here, that was at 52. You got up to 59 here before this ugly candle. I probably would have taken some off here. The 8 at that point was 56. Still a decent little gain in a couple of weeks. Big volume selling, that was just an ugly day, and you get these and you have to deal with them. How you handle with them, deal with it, might have to do with how big your position size is, but it had to shake out, and now it's kicking into another gear, trying to ride it higher again. Axon is another one, didn't quite work out. Big move on the gap up higher, day 2 higher high, had the volume, riding the gap up higher, and then riding the ADMA, okay, and then here's the first break of the ADMA, tried to get back above it and couldn't. Another day where you shook out, look like it's re-exerting itself, and then I think I read that this had an offering or a shelf offering in here, and that's what put the death knell to it. But um, acting fine above that 8 until it stopped doing it. You know, some of them go longer than others, but you follow the rules. You either get out with a small gain or small loss, or some of them can turn into very strong double-digit gains. PCAR, this has been another one. Big earnings shakeout day. Tried to break out, but didn't. But inside day, the next 2 days, riding the ADMA higher. Here's your first test of the 8. Continuing to ride it higher, another shakeout of the 8, and now finally flattening and rolling over as it goes into a little bit of consolidation. But if you bought at 95, it made it up here to 107. Double-digit gain in 3 weeks is nothing to laugh at in this market. I don't hear anybody talking about this one, but Air Products, not really good numbers, good sales numbers, not really good earnings numbers, but a gap up, a day 2 higher high, and just riding. This didn't even touch the 8 until 2 weeks afterwards. One day undercutting the 8, now it's at the top of this long base, putting in a little bit of a handle here. If you want to look at the weekly, I don't know a lot about Air Products, but I know that when you see 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks up in a row, that the stock is very clearly being accumulated, and it followed the gap up rules by riding the ADMA higher and the day 2 higher high. Pinduoduo, not much for Chinese stocks, but here's the gap up and continuing higher. 2-day pullback got to the ADMA, and then another gap up today, up 6%. IBM, believe it or not, gap up on earnings, day 2 higher high, keeps running from, so the day 1 close was 125, ran up to 140, pulled back to the 8. You could have got in here at the 8, and the next day when it reclaimed it, at about 135, ran up to 150 before it started going sideways, and now it's just consolidating along with the market. And finally, Gilead. Man, what a great one this is. Big gap up on earnings, 13% with the volume, nice tight sideways for 4 days. Not quite to the ADMA, but then moved out on the 5th day. So that was 80 up to 90, continuing, no sell signals at all here, just barely breaking the ADMA. So you've gone from 80 to 90 there in 3-4 weeks. So those are the rules that I look for the gap up and how to play them. I don't play all of them. There are other stocks in our portfolio as well as indexes, and you've got the market holding things back sometimes. So we've got rules to keep us from getting too heavy long. But those are a pretty good group of stocks there with a pretty decent set of rules to either keep your losses small or make some money off of them. That's going to wrap it. As always, love to hear from you. The email is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Feel free to reach out. Remember, it's not how much you make in the markets, it's how much of that you can keep. And we're here to remind you of that every day. So wrapping up Thursday, December 8th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great day.